Hey everyone, and welcome back to The Explainer. I am absolutely thrilled you're here learning with me today. It's May 11th, 2026, and let me tell you, the crypto market right now is moving way beyond just simple everyday price action. We are right in the thick of a massive, fundamental, structural transition. The entire foundation of how institutions and networks operate is literally shifting beneath our feet, and we're going to break down exactly what that means for the future of digital assets. Okay. Let's dive into this, because over the weekend, we saw Bitcoin confidently surge right past the $78,000 mark. So why did this happen? Well, a huge driver here is the easing of macroeconomic and geopolitical tensions. Specifically, Iran announced the reopening of the Strait of Hormuz following a ceasefire. That immediately eased market fears, dropped oil prices, and fueled a really heavy risk-on rally for Bitcoin. It's a classic example of how global macro events instantly ripple into digital asset valuations. So here is our roadmap for today's explainer. We've got 1. Beyond the price action. 2. Corporate treasuries pivot. 3. TradFi versus stablecoins. 4. Infrastructure and scaling up. 5. Red flags and scams. And 6. Market movers and momentum. I promise you, we are going to connect the dots between corporate debt, banking laws, and blockchain upgrades to make total sense of this chaotic daily news cycle. Let's jump right into Section 1, Beyond the Price Action. Underneath that flashy $78,000 headline price, there's actually a fascinating high-stakes tug-of-war happening behind the scenes. We are currently in the absolute definition of a high-volume consolidation phase. On one hand, you have miners who just recently sold off a staggering 32,000 Bitcoin into the market. Normally, that kind of heavy sell pressure would absolutely crush the price. But it is being met head-on and honestly completely absorbed by massive institutional demand. We are talking $700 million in recent fund inflows. It's a massive battle of supply and demand playing out in real time, and it's showing some incredible market resilience. Moving on to Section 2, Corporate Treasuries Pivot. Now, what's really interesting about this slide is the strategic shift we are seeing from Michael Saylor and strategy. Corporate giants are fundamentally changing how they handle their balance sheets. For years, their playbook was a pure HODL strategy, right? Buy the Bitcoin, hold it indefinitely. But Saylor recently revealed a major pivot to an active digital credit model. They are now prepared to actually sell Bitcoin to fund shareholder dividends and retire debt. It's a real double-edged sword. It brilliantly validates Bitcoin as a mature, yield-producing asset for corporate treasuries, for sure. But it also introduces a brand new source of regular, scheduled sell pressure that the broader market is going to have to absorb. And the corporate maneuvering doesn't stop there. Take a look at this massive number, $20 billion. That is the valuation Kraken's parent company, Payward, is actively seeking right now ahead of its planned IPO. They are using this massive war chest to fund a flurry of acquisitions across the derivatives and stablecoin sectors, including a recent deal to acquire the fully licensed U.S. crypto derivatives platform Bitnomial. They are aggressively stacking their regulatory and product decks to conquer the traditional finance world. Which brings us to Section 3, TradFi versus stablecoins. Let's shift the narrative to the escalating battleground between traditional banking and the rapidly growing $320 billion stablecoin industry. Just look at this stark warning from the American Bankers Association. The traditional banking sector is finally officially recognizing stablecoins not just as a niche tech experiment, but as a direct, systemic threat to their liquidity. They are terrified that customers will pull their cash out of low-yield bank accounts and trigger a massive deposit flight right into high-yield stablecoins. And that fear brings us straight to the Clarity Act. This is pending legislation where lawmakers are facing immense pressure from banking lobbies to impose strict limits on stablecoin yields just to protect traditional bank liquidity. This legislative friction absolutely matters to us because it's keeping stablecoin-linked assets like Ondo and XLM highly volatile in the short term, as the market weighs the very real risk of a government-mandated yield ban. But you know, stablecoin issuers aren't just sitting around waiting for regulators. They are actively shaping market trust themselves. Following a devastating $280 million exploit on the Drift protocol, Tether stepped right in with a $127 million rescue plan. By using their massive reserves to bail out users, Tether is aggressively challenging their competitors, improving the appeal of fast, centralized intervention to protect the ecosystem. Let's move to and see how this builds into Section 4, Infrastructure and Scaling Up. We're heading into the actual engine room of crypto technology. Because while the regulators fight, the developers are busy scaling up to handle all this new institutional demand. We can see major networks actively upgrading their infrastructure. First up, Solana's massive Alpenglow consensus overhaul has officially entered its testing phase, and its primary focus is network stability for institutional scaling. Then you've got Ripple Prime, which just secured a huge $200 million injection from Neuberger Berman to expand its institutional payment rails, especially after its revenue reportedly tripled. Finally, Ronin is migrating from a sidechain to a full Ethereum Layer 2 to permanently enhance its security and tokenomics following that historic 2022 exploit. The infrastructure is seriously maturing. Now for Section 5, Red Flags and Scams. It's a crucial reminder that alongside all of this structural maturity, the market still faces significant retail risks. We have to impartially look at the gold T1 phone scandal. According to investigators, $60 million in retail deposits have been collected for this Trump-themed device. However, these orders remain completely unfulfilled to buyers. Furthermore, the terms were quietly rewritten in April to explicitly remove delivery guarantees. Naturally, this has sparked widespread bad debt fears among retail investors. It is a stark reminder to always read the fine print. Finally, let's wrap up with Section 6, Market Movers and Momentum. And this brilliantly illustrates the assets reacting most strongly to this weekend's incredible news cycle. Over the weekend, we saw massive breakouts here. SUI absolutely crushed it with a 25% gain, and CRO pushed up almost 10%, significantly outperforming the broader market. It clearly shows that liquidity is actively searching for the next narrative within this structural evolution. So, what does this all mean? As the market navigates this complex Treasury and Trust transition, balancing corporate sell pressure, massive tech upgrades, and the fight for stablecoin dominance, can these breakout assets actually maintain their momentum against those looming regulatory battles in Washington? That is the ultimate question we will be tracking. Thank you so much for learning with me today in this explainer. Keep analyzing, keep questioning, and I invite you to stay curious. See you next time.